The shock is not the thing that destroys most investors. The shock only reveals who built a fragile system. That is the first principle I would want you to understand before you think about oil, Iran, inflation, technology, or the next big opportunity in the market. Most people look at a crisis and ask what is going to happen next week. That is the wrong question. A better question is, if the system is stressed, which businesses become more important, which businesses become less important, and which investors will have the discipline to buy quality when fear makes quality temporarily cheaper. That is how I think about the environment we are entering. The Iran shock, or any geopolitical shock that pushes energy prices higher, is not just a news event. It is a chain reaction. Oil moves, then transportation costs move, then production costs move, then inflation expectations move, then interest rate expectations move, then consumers get squeezed, then weaker businesses feel it, then markets reprice risk. That is the machine. You do not need to panic about the machine, but you do need to understand it. Because if you do not understand the machine, you will become one of the people the machine uses as fuel. When oil prices rise sharply, the impact is not isolated to oil companies. Oil sits underneath the real economy. It is in shipping, it is in manufacturing, it is in food distribution, it is in plastics, it is in chemicals, it is in the cost of getting almost anything from one place to another when that cost rises. The pressure goes everywhere. The store does not absorb it forever. The trucker does not absorb it forever. The manufacturer does not absorb it forever. Eventually, the pressure reaches the consumer. And once it reaches the consumer, the next part of the cycle begins. People spend less, margins compress. Small businesses that were already weak start to break. Debt that looked manageable in a calm environment becomes much harder to carry in a stressed environment. This is why oil shocks can become inflation shocks, and why inflation shocks can become economic shocks. The part that makes the situation especially difficult is that inflation limits what central banks can do when a normal downturn happens without an inflation problem. The central bank has a cleaner playbook. It can cut rates, it can inject liquidity, it can try to support demand. But when inflation is still hot, the central bank does not have the same freedom. If it cuts too aggressively, it may make inflation worse. If it does not cut, the economy may weaken. That is the uncomfortable place where stagflation risk lives. High inflation and weakening employment at the same time. That is the condition markets fear because it creates conflict inside the policy machine. The economy wants help. Inflation says no. The consumer wants relief. The central bank hesitates. Investors want certainty. The system produces volatility. This is the type of environment where people who do not understand cycles tend to make very emotional decisions. They sell good assets after they fall. They buy the thing that just went up. They chase the crisis trade after the crisis trade has already been priced. They confuse motion with strategy. They confuse fear with intelligence. I have seen this pattern many times. The reason changes, the pattern does not. One time the reason is an energy shock. Another time it is a banking crisis. Another time it is a debt problem. Another time it is a technology bubble. Another time it is a pandemic. Another time it is inflation. Another time it is war. The cause is different, but the market machine behaves in ways that are highly repetitive because human nature is repetitive. Fear repeats, greed repeats, leverage repeats, overconfidence repeats, forced selling repeats. And then after enough pain, opportunity repeats. That is why a crash does not automatically frighten a prepared investor. A crash is not good if you are over-leveraged, undisciplined, concentrated in weak companies, or forced to sell. But if you hold quality, have liquidity, have a system, and understand what you are trying to buy before the fear comes, a crash can become one of the most important wealth building moments of a decade. This is where most people misunderstand long-term investing. Long-term investing does not mean ignoring the world. It does not mean pretending oil prices, wars, inflation, interest rates, and debt cycles do not matter. It means seeing those forces as part of the weather system and preparing before the storm forces you to make decisions under stress. When everyone is comfortable, opportunity is usually expensive. When everyone is afraid, quality can become mispriced. That is when the prepared investor starts to work. But you cannot simply buy anything that falls. That is not investing. That is gambling with a calmer vocabulary. A bad company that falls 60% is not automatically cheap. It may be a bad company being repriced correctly. A highly leveraged company that collapses in a high-rate environment is not necessarily an opportunity. It may be a debt problem becoming visible. A commodity that spikes in a crisis is not necessarily a long-term investment. It may simply be a cyclical instrument doing what cyclical instruments do. This is why my approach is not to chase oil. Just because oil is moving, oil can rise for 3 months, 6 months, 12 months, or longer. But oil is a cyclical asset. It moves with supply, demand, geopolitics, inventory, OPEC decisions, drilling incentives, and global growth. It can go very high, it can come back down, it can make people look brilliant for a short period, and then punish them when the cycle turns. That is not the kind of long-term compounding machine I want at the center of a portfolio. The same logic applies to going entirely into cash. Cash feels safe because the number does not move much. But the purchasing power moves. Inflation is the silent tax on people who confuse nominal stability with real safety. Over long periods, the market has gone through crashes, recessions, wars, pandemics, bubbles, and long sideways periods. But cash has suffered a different kind of drawdown. It loses purchasing power quietly. Most people feel a market crash because it is visible. They do not feel inflation with the same emotional intensity because inflation is gradual. But gradual destruction is still destruction. In many ways, inflation is more dangerous than a crash because a crash creates fear. And fear can create opportunity. Inflation just reduces the value of your money while making you feel responsible for working harder to stand still. So I do not build a long-term strategy around hiding in cash. I also do not build a long-term strategy around buying whatever goes up during a war or buying defensive stocks, simply because the world feels dangerous. Defense contractors may benefit for a period. Consumer staples may hold up for a period. Telecom or healthcare may become places people hide during fear. But hiding is not the same as building a portfolio meant for the next 10 or 15 years needs to own the engines of productivity. Power, automation, infrastructure, and decision making that become more valuable as the world gets more complex. That is the real opportunity. Not the crisis itself. The opportunity is using the crisis to buy the businesses that will matter after the crisis. This is a very different mindset from trading headlines. The headline says Iran, the system says energy costs, inflation pressure, central bank constraints, consumer weakness, market volatility, and eventually a repricing of long-term winners. That is the chain. If you can see the chain, you can act with more calm. If you cannot see the chain will act on you. So when I think about what I would want to own through a decade like this, I start with businesses that solve real bottlenecks. The first bottleneck is power. Artificial intelligence is not just a software story, it is a power story. The more the world builds AI data centers, the more the system needs reliable electricity, cooling, and infrastructure. People talk about models, they talk about chips, they talk about applications, but beneath all of that is the physical world, electricity, cooling. Data centers, grid constraints, on-site production, nuclear capacity. If the system does not have enough power, the system cannot run the intelligence layer people are so excited about. That is why I pay close attention to companies connected to reliable energy and AI infrastructure. I am not talking about buying oil because oil went up this week. I am talking about owning the businesses that help the next technology cycle function in a world where the grid is strained and the demand for power keeps rising. In that group, there are companies like CG, which is tied to nuclear exposure. There are companies like VRT, which is tied to cooling and infrastructure around data centers. There are companies like Bloom Energy, which is tied to on-site power production that is less dependent on the traditional grid. These are not the same thing as buying a barrel of oil. They are connected to a broader structural need when a society becomes more digital, more automated, and more AI-driven. It needs more power. When geopolitical pressure makes energy security more important, it needs more resilient infrastructure when the grid is not enough. Solutions outside the grid become more valuable. That is the thesis. The second bottleneck is memory. This is less exciting to many people because it is not as visible. But the market does not reward what is exciting forever. It rewards what becomes necessary. AI systems are becoming more complex. The more complex they become, the more memory they require. More agents, more context, more data movement, more high bandwidth memory, more ability to process and retain large amounts of information quickly. This creates pressure on memory supply. And memory supply is not something you can create overnight. Production capacity takes time. Technology transitions take time. Factories take time. Supply chains take time. That means when demand rises faster than supply can respond, the existing leaders can become very important. The memory market is highly concentrated. A small number of companies controls most of the market. That creates a different kind of opportunity. The world may decide it needs much more memory very quickly, but the production system cannot instantly give the world everything it wants. This is why I would pay attention to Micron. Micron is a US-centric way to express the memory bottleneck in an AI cycle. The stock may be volatile. It may be down from where people first became enthusiastic. That does not automatically make the thesis broken. In fact, if the underlying revenue growth, free cash flow improvement, and high bandwidth memory positioning remain intact, volatility can become part of the buying opportunity rather than proof that the idea failed. The key is not whether the stock went down after you first looked at it. The key is whether the long-term bottleneck is real and whether the company is positioned to benefit from it. This is where investors need principles. If you buy a company because of a story and sell it because of a price movement, you do not have a strategy. You have emotion with a brokerage account. If you buy because the causal chain makes sense, then you need to keep checking whether the causal chain is still intact. For memory, the chain is simple. AI complexity rises. Memory intensity rises. Supply cannot be created instantly. The leaders gain pricing power and demand visibility. That is the system I would watch. The next bottleneck is production. AI does not exist without chips. Chips do not exist without fabrication. Fabrication does not exist without advanced tools. Advanced tools do not exist without lithography, design software, connectivity, and a network of specialized companies that most people only learn about after the returns have already happened. This is why the production side of AI matters. NVIDIA and AMD are part of the GPU solution. ASML is tied to the lithography machines that make advanced semiconductor manufacturing possible. TSMC is tied to the production of the actual semiconductors. ARM and Cadence are tied to design and software layers. AEE is tied to connectivity. Each one sits in a different part of the production chain. In a calm world, this chain matters. In a chaotic world, it matters even more because when geopolitics becomes unstable, supply chains are no longer background infrastructure. They become strategic infrastructure. Governments care, companies care, investors care, customers care. The ability to produce, design, connect, and secure the semiconductor ecosystem becomes a matter of national competitiveness and corporate survival. That does not mean every stock in the chain should be bought at any price. Price matters, risk matters, position sizing matters, but the theme matters too. If the world is becoming more dependent on AI, and AI is becoming more dependent on advanced chips, and advanced chips are becoming more strategically important, then the companies that control the critical nodes in that chain deserve serious attention. This is the type of thinking I prefer, not what is the hot stock today. But where are the bottlenecks in the system? Where is the world underinvested relative to future demand? Where does chaos increase the importance of the product rather than reduce it? Where is the business so important that customers cannot easily cut it during uncertainty? That brings me to another category: decision-making in chaos. The more complex the world becomes, the more valuable systems become that help institutions make better decisions. In calm environments, bad decision-making can be hidden for a long time. In chaotic environments, bad decision-making becomes expensive very quickly. A supply chain breaks. A war changes assumptions. A cyber attack creates risk. A government contract shifts. A company needs to know where its inventory is, where its exposure is, where its vulnerabilities are, and what action creates the best expected outcome. That is why I look at companies like Palantir. Palantir is not just a software company in the simple sense. The reason it matters is that it helps organizations make decisions under complexity. That is valuable in ordinary times. It is more valuable in chaotic times. CrowdStrike plays a related role in cybersecurity. When the world becomes more digital, the attack surface expands. When chaos rises, attacks and vulnerabilities tend to rise with it. Datadog and MongoDB sit in the data visibility, monitoring, and database side of the world. Oracle, Microsoft, Google, and Amazon have roles in cloud and infrastructure. Each is different, but the broad principle is the same. In a world where complexity increases, tools that help institutions see, decide, protect, process, and scale become more important. I want to own the businesses that make the complex world more manageable. That is a very Dalio way to look at it because it is about systems, not slogans. What system is being stressed? What capability becomes more important when the system is stressed? Which businesses provide that capability? Which of those businesses have strong fundamentals? Which of them are mission critical? Which of them can keep improving margins and revenue through volatility? And then when fear sells them off, how do I buy them without losing discipline? That is the process. The next area is automation and real-world productivity. When costs rise, businesses look for productivity. When labor is expensive, businesses look for automation. When uncertainty rises, businesses look for tools that reduce friction, improve efficiency, and make operations less fragile. That is why I think about Tesla, Meta, Amazon, SoFi, and Robinhood in a broader productivity and platform category. Tesla has robotics and autonomous driving exposure. Meta has one of the strongest advertising platforms and can keep improving the efficiency of digital advertising. Amazon has a rare combination of cloud infrastructure and retail data. SoFi represents a financial technology platform that has already been on the radar for some time. Robinhood also has a place in the conversation because it sits inside the broader transformation of how individuals interact with financial markets. These names are not identical. They should not be treated as identical, but they all connect to an economy where digital platforms, automation, data, and productivity become more important. This is the portfolio question. How do you combine all of this without turning the portfolio into a collection of exciting stories? Because having the right companies is not the same as having the right system. Most investors fail, not because they never hear good ideas. They fail because they do not have a process for buying, sizing, holding, and adding. They buy too much too soon. They use margin. They panic buy. They panic sell. They believe they can identify the exact bottom. They cannot. I cannot. No one can do that reliably. So I prefer a system built around gradual accumulation, dollar cost averaging, buying slowly, adding when the market gives you better prices, keeping enough patience and enough liquidity to survive a long buying process. The bottom is not an event you can schedule. It is usually a process. Markets can decline, bounce, decline again, and create multiple moments where investors think the worst is over before the real bottom is formed. If you spend all your capital early, you lose optionality. If you use debt, you lose time. If you use margin, you can be right on the long term and still be destroyed in the short term. That is why I would not use margin. I would not borrow to buy volatility. I would not build a strategy that requires the market to reward me immediately. A good strategy should allow you to be early without being destroyed. That is a very important principle. The portfolio should also have a core. For most people, a broad market core like the S&P 500 still matters. It is dangerous to believe you can outperform the market only with individual stocks if you do not have the skill, temperament, and system to do it. Many people try. Most do not succeed. A core gives you exposure to the overall productive capacity of the economy. Then, around that core, you can build sleeves connected to the structural themes you believe are most important: power, memory, semiconductor production, decision systems, cybersecurity, cloud infrastructure, automation, financial technology, productivity platforms. But those sleeves need rules. How much can any one company be? How much can any one theme be? How much are you willing to lose before the thesis is wrong? What facts would change your mind? What price would make the opportunity attractive? What price would make the risk too high? Most investors never answer these questions before they buy. They answer them emotionally after the stock has already moved. That is backward. The time to define the system is before the shock, because once the shock arrives, your nervous system wants to take over. Your brain starts searching for certainty. The media gives you panic. Social media gives you overconfidence. Markets give you red numbers. And unless you have principles, you will confuse urgency with importance. I am not stressed by shocks because shocks are part of the system. That does not mean I enjoy them. It means I respect them. History shows that bear markets happen, bull markets happen, wars happen, recessions happen, pandemics happen, bubbles happen, policy mistakes happen, inflation happens. But the productive engine of the economy does not permanently stop unless the system itself breaks. Over long periods, revenues and profits are what matter, not headlines, not opinions, not the daily argument over valuation multiples. Those things can dominate the short term. They do not dominate the long term. If a company can keep growing revenue, improving margins, expanding its role in the system, and strengthening its competitive position, the market eventually follows the fundamentals. It may not follow next week, it may not follow next month, but over time, the gravity of fundamentals is powerful. That is why I care so much about gross margins, operating margins, net income margins, revenue development, and the ability of a company to turn strategic importance into financial results. A high price-to-earnings ratio can scare people. Insider selling can create noise. Competition can be exaggerated. Narratives can swing from euphoria to despair. But the real question is whether the business is getting stronger or weaker. Is the revenue base growing? Are margins improving? Is the product becoming more necessary? Is the customer base expanding? Is the company more important to the system than it was 5 years ago? If the answer is yes, then volatility may be a friend if you have the right time horizon and position size. This is how I would think about a company like Palantir. People can argue about valuation, they can argue about government exposure, they can argue about competition, they can argue about whether the story is too popular. But over the long term, what matters is whether the company continues to improve its financial machine and become more essential to customers who need better decisions in a chaotic world. Price will move around that reality. Sometimes it will get ahead of reality, sometimes it will fall behind reality, but reality matters most. The same principle applies across the other companies and categories. Do not worship the ticker. Study the machine. Do not fall in love with the story. Watch the numbers. Do not chase the crisis. Prepare a shopping list before the crisis makes the shopping list emotionally difficult to use. That is what I would do if the Iran shock becomes larger and oil pressure rises. The market may sell off quality companies together with weak companies. That is what markets often do during stress. They sell what is liquid. They sell what is gains. They sell what investors can sell, not always what should be sold. This creates broad pressure, and broad pressure can create mispricing. That is the moment disciplined investors prepare for. But the preparation must happen before the fear. You decide the categories, you decide the companies, you decide the position sizes, you decide the entry system, you decide the rules around adding, you decide what facts would break the thesis. Then when the market offers lower prices, you are not improvising, you are executing. That is the difference between a prepared investor and an emotional investor. The emotional investor asks, should I buy now? When the screen is already red, the prepared investor says, this is the environment I built the system for. The emotional investor sees a crash and thinks the world is ending. The prepared investor sees a crash and asks which high-quality businesses are being sold for reasons that do not damage their long-term earning power. The emotional investor buys all at once because fear of missing out turns into fear of not catching the bottom. The prepared investor buys in stages because he understands that bottoms are usually built, not announced. This is why dollar cost averaging matters. It is not just a mechanical habit, it is a psychological protection system. It keeps you from needing to be perfectly right. It prevents you from turning every purchase into a prediction. It lets you participate while preserving the ability to act. Again, that is how you survive volatility. And survival is the key term. A great company that survives a crash and continues to compound can become a generational wealth creator. But an investor who does not survive the crash cannot benefit from the company. That is why the best company in the world is not enough if the investor has the wrong structure. You need strong companies and a strong process. One without the other is fragile. Amazon is a good example of the general principle. It went through deep drawdowns in major cycles, but the business survived, adapted, and became vastly more valuable over time. The lesson is not that every fallen stock becomes Amazon. That is a dangerous belief. The lesson is that when a truly strong business survives a crisis and continues improving, the crisis can become the entry point that changes long-term results. That is what I would be looking for now. Not the stock that went up because oil went up, not the company that is popular because fear is popular, not the defensive trade that gives people emotional comfort for a quarter. I would look for the businesses that become more important because of the structural direction of the world. AI needs power. AI needs memory. AI needs chips. Chips need production systems. Complex institutions need decision systems. Digital economies need cybersecurity. Businesses under pressure need automation and productivity. Consumers and companies under cost pressure need platforms that make financial and operational systems more efficient. That is the map. Then I would wait for the market to give me better prices. That is the discipline. And I would never confuse a watch list with a buy order. A watch list is preparation. A buy order is execution. Between the two, there must be rules. If a business is high quality but the price is unreasonable, I can wait. If the price comes down but the thesis is broken, I do not buy. If the price comes down and the thesis is intact, I begin to act in stages. That is the whole game. It sounds simple, it is not easy. The hard part is temperament. The hard part is watching people panic and not becoming one of them. The hard part is watching people get rich quickly in something you do not own and not abandoning your system. The hard part is buying slowly when every part of your body wants certainty. The hard part is holding quality through noise when the news gives you a new reason to doubt every morning. But this is why principles matter. Principles reduce the number of decisions you make under emotional pressure. They do not eliminate uncertainty, they help you operate inside uncertainty. So if I were preparing for the next shock, I would not start by asking what the headline will be tomorrow. I would start with the structural questions. Where is inflation pressure coming from? How does it affect central banks? How does it affect consumers? How does it affect weak businesses? Which businesses become more necessary when the system is under stress? Which long-term winners might be sold simply because the market is afraid? How do I buy them without betting everything on one entry point? How do I avoid leverage? How do I keep enough cash to act again? How do I keep a broad core so that I am not dependent on being right about every individual name? That is how I would build the process. And if the market does fall because oil prices, geopolitical risk, and inflation fear collide, I would not treat that as proof that investing is broken. I would treat it as part of the cycle. The world does not move in a straight line. Markets do not move in a straight line. Wealth is not built in a straight line. It is built by understanding repeated patterns, preparing before they happen, acting when others are emotional, and surviving long enough for strong businesses to express their earning power. That is the key. Survive. Stay liquid, avoid debt, own quality, add slowly, think in systems, follow fundamentals, respect cycles. Do not let fear choose your portfolio. Do not let excitement choose your portfolio either. The same emotional machinery that makes people sell the bottom also makes them buy the top. Both are dangerous. A good investor must be able to stand apart from the crowd twice, once when everyone is euphoric. Again, when everyone is terrified. That is not because he is smarter, it is because he has a process. So when people say, the shock is coming, I do not dismiss it. I also do not worship it. I put it into the machine. Higher oil can create inflation pressure. Inflation pressure can constrain the Fed. A constrained Fed can increase economic pressure. Economic pressure can create market weakness. Market weakness can create opportunity and quality businesses tied to the future. That is the chain. The chain is what matters. If you follow only the headline, you will feel fear. If you follow the chain, you can make decisions. And that is what investing really is. It is decision making under uncertainty, not prediction, not entertainment, not reacting to noise. It is building a system that lets you behave well when the world behaves badly. The next decade will likely be defined by more complexity, not less. More geopolitical shocks, more energy constraints, more AI infrastructure demand, more supply chain sensitivity, more cyber risk, more automation, more pressure on productivity, more need for capital discipline. That environment will punish investors who need everything to be calm before they can act. It will reward investors who understand that uncertainty is not the enemy. Fragility is the enemy. Being overleveraged is the enemy. Owning weak businesses is the enemy. Having no process is the enemy. Selling quality because the news is loud is the enemy. Holding cash forever because volatility feels uncomfortable is the enemy. If you understand that, the shock becomes different. It is no longer just a threat. It is a test. It tests your portfolio. It tests your temperament. It tests your liquidity. It tests whether you actually believe in your system or only liked it when prices were going up. And if you pass that test, It can also become an opportunity, not because crisis is good, crisis is painful, but because markets sometimes price great businesses as if the pain will last forever. It usually does not. The world adapts. Companies adapt, capital moves, innovation continues, productivity improves, and the best businesses use the chaos to strengthen their position while weaker competitors fall away. That is why I would be calm, not complacent. Calm. Calm means I know there is risk. Calm means I know I cannot predict the exact sequence. Calm means I know my job is not to guess every headline. Calm means I have a watch list. Calm means I have a buying system. Calm means I know which businesses matter to the future and which trades are just emotional reactions to the present. Calm means I do not need the market to validate me this week. That is the type of investor I would want you to become. Because the world will always give you reasons to be afraid. There will always be wars. There will always be recessions. There will always be bubbles. There will always be crashes. There will always be people telling you this time is different in a way that means you should abandon discipline. Sometimes the facts are different. The human behavior is usually the same. The prepared minority understands that. They do not try to avoid every storm. They build a portfolio and a process that can move through storms. And when the storm forces other people to sell great businesses at worse prices, they act. That is how generational opportunities usually appear. Not with a bell, not with comfort, not with the majority agreeing. They appear when the world feels uncertain enough to make good assets temporarily unpopular. So my answer to the coming shock is not panic, it is preparation. I would prepare by understanding the energy chain. I would prepare by understanding the AI power demand. I would prepare by understanding the memory bottleneck. I would prepare by understanding the semiconductor production stack. I would prepare by understanding decision systems and cybersecurity. I would prepare by understanding automation and productivity platforms. I would prepare by building a core, sizing positions rationally, avoiding leverage, and buying slowly. I would prepare by looking at fundamentals, not noise, and then I would wait, because the market will give opportunities to people who are ready. It always does. The only question is whether you will be emotionally and financially prepared when it happens. Most people will not be. They will wait until the shock arrives. They will feel fear. They will ask for certainty. They will watch lower prices and interpret them as danger. Then, after the recovery begins, they will ask why they missed it. That cycle has repeated for generations. You do not have to repeat it. You can study the machine, you can build the system, you can make your list before the panic, you can decide your rules before your emotions get loud. You can use volatility instead of being used by volatility. That is the opportunity, not the oil spike, not the headline, not the panic. The opportunity is that most investors will react, while a prepared minority will allocate. That difference, repeated over a decade, can change everything. So when you hear people say history is about to be made, remember this: history is always being made. The more important question is whether your process is strong enough to benefit from the part of history that scares everyone else. That is what I would focus on. Not fear, not hype, not prediction, a durable system, a clear map, a disciplined list, a patient buying process, and the humility to know that the market can fall further than you expect before it gives you the reward you deserve. If you can do that, you are not simply trying to survive the next shock. You are positioning yourself to use it. That is how wealth is built when the world becomes unstable. Not by pretending instability will not come, by preparing for it before everyone else is forced to react.